Hi, my name's David Linton, and this series of lessons is designed to help you get the most from the price targets. And today we're going to focus on using them on Updata, and this can be watched as a series of 10 lessons. If you're taking a trial for the first time, you'll get a lesson each day, or you can watch the entire video right the way through. But hopefully this will help build your understanding of the price targets and ensure that you get the very most from them. So these are the top tips really in using the targets, and I urge you to really just do this session. A little bit about me. I have been doing technical analysis for over 40 years. I started trading London traded options. It's been my life. I founded Updata over 2 decades ago. I'm qualified. I've got a master's in financial technical analysis, which is only held by around 100 people globally. It's awarded by the International Federation of Technical Analysts. And that's a really important point, actually, is that anyone who's teaching you, it's really important that they are qualified and experienced. So you need both the qualifications and the experience. And I've trained hundreds of traders and thousands of traders actually globally in over 30 countries. I run trading courses. I teach part of the diploma course for the Society of Technical Analysts. I've written books and I speak at conferences and I'm a regular commentator. So you've probably come across my work before, and you can follow me each day at chartstoday.com where I record a session. I'll talk a bit more about following me through this session. But the key thing is that the price targets are going onto more and more platforms all the time. And so they're on Bloomberg. And in fact, I've got them running here on my Bloomberg. So these are the targets on Bloomberg. They're on TradingView as well. So, and they're being added to more and more platforms. And so one of the key things about using the targets is that they're most flexible in the Updata Analytics environment, and that's the platform that I use, obviously. And this is where the targets were first developed and are being continued to be developed, with those other platforms catching up. And the key thing is we have much more flexibility here with our control of the code with our own programming team. And of course, you can run Updata on dozens of different data services. So I'm running here on Bloomberg and on LSEG Workspace and Montel, and you can be running on lots of different data services. But also, they're being rolled out onto other platforms. But as I mentioned, the real issue is how much control we have on the coding in those platforms. So they're on Bloomberg. They've been on Bloomberg now for over a year, and that's been more and more successful. People are taking them on Bloomberg more and more. If that's the platform you've already got, that means you can just click a switch and you've got the targets. On TradingView, you literally can go to the Updata website, and on the Updata website, you can actually just get them for TradingView. So you can effectively download them there and use them in your TradingView system. But of course, as I mentioned, I use them on Updata. And they're coming on a whole series of new platforms. I'm actually in the US next week, seeing a series of providers that are looking to implement the targets on their platforms. And so it'll be a matter of time before they're more widely available. The key thing for us is that we've got 3 development tracks. We've got to improve the targets in Updata Analytics, and today I'm going to show you a lot of the new improvements for the targets. We've got to add more data services so that you can run them in Updata Analytics on more and more data services. And then we've got to add them on more platforms. So we're being pulled in 3 directions here in terms of improving them in our own platform, adding more data services so that people can use those data services into our own platform, and then putting them on more and more platforms that people readily use. So it's a challenge, and that's what we have to do. And if you would like to see them on platforms that you're already using, please just email t@updata.co.uk. I will see that, and we are always happy to talk to any platform provider about adding the targets in. So the flexibility in Updata is really the big key, and this can often come down to well, firstly, the programming code. So in Bloomberg, it's it's a slightly different coding environment, and it's a bit limiting. And in the case of TradingView, it's a scripting language, and this latest one we're adding on is a Java language. So they've got to be written in different computer languages, and then all of those have got to be managed and grown separately. So it's quite a challenge, and each platform is slightly different. But the key thing is in Updata, we've got a lot more control over the code. So for example, on Bloomberg, we would very much like to see these windows so that we can change these to the things that people would like to use most, where we don't have that level of control. We have to ask Bloomberg, and they're not always that quick to make the changes that we want. And equally in TradingView, it's a scripting language. So whilst it's very, very powerful in TradingView for looking at different charts and looking at the targets, the thing is, it is a scripting language, and when it comes to things like settings, we have no real control over how these dialogues look. So you end up with very long dialogues, whereas in Updata, we can span multiple dialogues because we control the programming code. So they are by far and away the best and more flexible, and being developed in first and foremost in Updata, with the other platforms then catching up. And today I'm going to show you some of these new powerful features that you can run in Updata in the new version. And so when you go to Updata, do just check for updates. You can go here in the help menu and check for updates and get the latest release version that will have these features. So the key thing about Updata is we have power in that we have the keystrokes. So you can just in Updata, you can, on any chart you like, you can literally take a chart. And if I take a chart of silver, for example, and that is automatically just drawing the levels on there. I'll talk about the levels, but if I press the T key, it puts the targets on. And a new addition is that actually the A and X keys have been configured in Updata so that you can change the slope of the targets. And I'll talk a little bit about that. But do be careful about pushing those keys really quickly, because you'll end up creating a little bit of an issue with creating a buffer. So you've just got to be a bit patient with those keys. But here we're seeing the 60-minute chart. It changes the unit size, and now we've got a short-term chart with short-term targets. So the key thing is that in Updata, we have a lot more ability to control the code and a lot more ability to improve the targets. Although once we've made improvements in Updata, we then go to the other platforms and we'll add those improvements as best we can. So the keystrokes is something that we have control over, which we don't have in other platforms. The tracker charts, which is, if you watch charts today, you'll be very familiar with this, where I go on different charts and it literally just changes the chart. And again, this is something that's really very powerful within Updata that we don't have much control over in other platforms. So that is another factor that is really quite key in Updata. So that is something that we do value, and hopefully as a user you will value that. In TradingView, they've got something that's quite similar in that you can click on each of these items and it will put the targets on for you as you click on each one. So that's nearly as good as a tracker chart. You can go down the list with a cursor. So actually it's pretty good in that regard. But more and more difficult to do in platforms like Bloomberg, where we don't have that level of control. And then the scanning is a very powerful aspect in Updata Analytics. which I'll talk about at the end, and back testing, which we are starting to do more and more of. Again, I'll talk about at the end. And the new tools and features will always come first in Updata. So that's just a key factor. And today I'm going to talk to you about some of the new tools that have been put into Updata that will ultimately go on the other platforms. So these tools are not just about targets, and I think that's a really important thing. The targets are the most powerful aspect, no doubt, because it's really a groundbreaking thing to put price targets on the chart, fully automated. But things like automated support and resistance people value, and that's really important when we look at the targets. The midpoint average, and another feature that we can develop from that is the OBOS indicator. And then we'll talk about target on balance volume and target stop losses, and these are new. But the key thing to remember is this idea of trends, levels, targets, stops. And I really think that's the important thing, is the targets in isolation are not anywhere near as powerful unless you can think about the trend, the levels, the targets, and the stops. And when I say trend, we're talking about multiple trends, because you can be looking at different time frames. And the stops is the new addition, which we'll spend some time on today. So in Murphy's book, chapter 16 on money management, sadly John died a couple of months ago, a great man, really the father or the grandfather of technical analysis. This book is a masterpiece. You really do need to have it. And a lot of, it's been a big inspiration to a lot of my work. And in his book, he talks about price forecasting, trading tactics, and money management. And the price forecasting is the bit really that's really powerful in terms of using the targets. So that's really just, this comes from our training course. We have a section on money management in our training course, which I give to institutions globally, and that you can get that training course online. It's a 12-hour training course, which I cover nearly all aspects of technical analysis. Now, the key thing about this is that the trend is you're deciding on the trade. That's the analysis. You've got a target. You're breaking critical levels. So that's a timing thing where you're starting to think about entering the trade. These two are often very close together. And then you've got the price target. And once you're in the trade, it's very much about managing the trade and monitoring. And so this is where the stop losses is a really vital part of the targets. So the top 10 tips, the first one is just remembering where the targets come from. So we're going to start with that as your first tip of the top 10 tips. And this is the key thing. So if you're watching these across a series of days, day one, remembering where the targets come from. It's an old technical analysis technique reimagined. Now, remember, these targets are derived from point and figure charts. Now, point and figure charts, when we had the ticker tape back in the day, it was too difficult to record all the prices coming out in the ticker tape, obviously pre-computers, and even if you tried to record it and graph them all. So this was a shorthand that was a necessary shorthand, and it became a kind of filter for noise. You only recorded the big round numbers. And so this is really where this comes from. The book that was groundbreaking was Abe Cohen's book. I've got this book. It's a rare book. And this is Abe Cohen's The Chartcraft Method, where he developed the targets, the vertical price targets. He developed horizontal ones as well. But in terms of the price targets that we're looking at on these charts, they're derived from Cohen's method. Now, if you want to fully understand point and figure, the definitive book is Jeremy Duplessis' book. I helped edit this book. I worked with Jeremy for 15 years, and I'm eternally grateful to him, really, for really putting point and figure back in my mind. I studied it in the early days, but like so many people, and this is the main reason for putting the targets on time-based charts, so many people don't use point and figure anymore, and it's really sad that this price target method has been lost, and this is a way of bringing them back into the mainstream. So it's not that I invented this, it is something that we've just reimagined. We've taken it from one chart and we're displaying it in another way. And so, that is really critical. And I get lots of people saying to me, oh, I love point and figure. I remember doing those. And I say, yeah, when did you last look at a point and figure chart? They say, oh, not for years. And so, this is a real issue. And again, in Updata's point and figure is by far and away the best in the world. You could say, well, you would say that, wouldn't you? But the reality is I can take this chart, if I look at the 60-minute chart with the targets on, so I can just go and put the targets on the 60-minute chart like that. But if I was to do this as a point and figure chart, and I did it as a 60-minute chart, we would see, and the unit size I've got here is 0.1%, so I'm going to do the same chart, and if I hit the Shift T key, it's going to put all of those targets on there. So that's the same targets on a point and figure chart that are now on a line-based chart, and most people will find this chart is this chart here is much easier to read than that chart there with the targets on is much easier to read than the point and figure chart. But it's the same chart, and that 5255, that's that target there. So it's really key. And those targets were given a period ago. So Updata's point and figure is by far and away the best in the world. The problem is most people don't want to use point and figure charts. They find them difficult to understand, and so that's where the targets come from. So the key aspect about point and figure as well is that there's no time in a point and figure chart. It's reversals, and so that's the bit that people also find difficult, they struggle with. And so this is where putting these targets onto a time-based chart and trying to project them into the future adds some extra value. So here we see a chart of Goldman Sachs, and that chart there is actually that chart there with the targets on, and it's easier to watch the price following the target trajectory. So that's it really. The targets have been peer reviewed in the International Federation of Technical Analysis Journal 2025. So you can go to this, you can go to the IFTA website, and if you look up journal, you'll be able to download this and read the paper that was peer reviewed there. So I'm going to give you lots of resources. We can learn more about these targets. If you go to the Updata website, under resources, there's videos. There's lots of videos on the targets, and this one will go there as well. So this is the latest one. And there's lots of other technical analysis resources there too. And you can see them in use every day. I record every morning chartstoday.com, and I do a 10-minute wrap of what's going on in the markets, what's changed, what new targets have come in. A target's just been activated on gold, for example, and I point that out, and it's designed to help you side by side in terms of getting the most from the targets as well. We have a lot of institutional clients using them, and I write reports. I write a report every morning on energy for our institutional clients, where we're using the targets on very short-term charts, 60-minute and 10-minute charts, and in the commentary I'm even using 1-minute charts, so you can use them on real-time markets. And I also write a weekly commodities report. So I'm using them all the time, as are many of our clients. I'm posting charts with targets on LinkedIn all the time, so you can follow me on LinkedIn. I've got 34,000 followers there. You can join those followers, and you can follow me on LinkedIn as well. So that's a really key place to just see regular updates of the targets in use. So lots and lots of places. Now, targets are about thrust, and I've got a cricket ball here, and the idea is if you're on the far outfield of a cricket pitch, to be able to throw this ball all the way to the middle of the ground, you're going to need to pull your arm all the way back. It's not going to work if you just do it from here. You're going to have to pull your arm all the way back and give it a really good thrust, which will then in turn mean that it goes further. So targets are very much about thrust, and it's this. These are the rules effectively. You need an uninterrupted buying thrust off a low. You then need a pullback, and that pullback needs to be significant, and that locks that first wave of buying in this instance. And then you need to move at least 1 unit higher, and that activates the target. So you've got basically a buying thrust off a low, a minimum pullback, and then that move above the initial buying thrust activates those buyers. Those buyers effectively do not need to sell. This is the overall potential, and it's based on the point and figure rule of 3. So this is the first third, and there's another 2/3 to the target. The target structure is here, and it's in that paper, and these slides will also be made available, that you can download the slides and go through it. But the key point is this is the setup. The target principle is really very simple. These buying thrusts here of low points generate these targets. And so this target is not as big because the buying thrust is not as big. This buying thrust is bigger, and so therefore the target is bigger. So here we have these buying thrusts, which then we activate those buying thrusts with a move a further unit above, and then these leads to these price targets to the target price. And so we'll talk about that, but it's a very simple principle that it's looking for buying and selling thrusts. The other advantage of doing them on time-based charts is you can use them in line with other charts. So here they are with Bollinger Bands, and I'm a big fan of John Bollinger. I know him reasonably well, and I see him almost every year, I guess, at conferences and things. And he was, he's the first to say new ways to move technical analysis into modern age without abandoning the past. And this is, John has actually been a really good encouragement of these targets and has said some very nice things about them publicly too. So that's day one. The key point is just understanding where they come from, and then where to follow me and how to get the most from using them in Updata. The next lesson is going to look at your chart frame time horizon. So set yourself up tomorrow for the next chart, or continue watching the full video. So it's day two. What's your time horizon, your chart frame, and this idea of unit size? And this is really important when we use price targets. Time horizon is vital. Now, I developed this chart actually in my Cloud Charts book I wrote in 2010. I developed this time horizon table, and it's a really key aspect where we think, if we're looking at a daily chart, we're thinking weeks ahead. If we're looking at a weekly chart, we're thinking months ahead. If we're looking at a 60-minute chart, we're thinking days ahead. So chart frame is a form of filter that filters out noise as well. Now, with point and figure, it was the box size, but for time-based charts, it's the chart frame. And so on a medium-term chart, we use a unit of 0.5%. I use log scale charts mostly. I'll talk about that in these lessons. But if I change this unit size, it will change the targets, because the formula is such for each buying thrust. These are the units that have been passed through on the point and figure chart that generate the targets. The key thing here is 0.5% seems to work best on daily charts. So that's what I use as a 0.5% log scale, which we will explore in the lessons. On a 60-minute chart, I go down to 0.05 or 0.1%, and that is a smaller unit size because now the granularity of the chart is smaller, and this highlights the difference between a short-term chart and a medium-term chart. So this is US 10-year yields, and then if we look at the this chart, we've got short-term targets, and that often gives me a heads up as to whether this target will be activated or not. I can look to the shorter term time frames. And then the longer term is a weekly chart. Now, point and figure would typically use the tick data and not weekly. But the really valuable thing about doing it on weekly data is that you can basically get time projections a long way into the future that is showing you roughly when those targets might be met, which you can't do on a point and figure chart. And so you would not normally do a weekly chart with point and figure, but I do feel that it has value in the time projections, and again we'll cover that in a little bit more detail. So the definition of a point and figure breakout or a breakdown is this. It is what we call the double top buy, which is boxes, which leads to this, or the double bottom sell, which leads to this. And this is not to be confused with a double top or double bottom. And you differentiate it by saying a double top buy signal and a double bottom sell signal. And these, again, were in Cohen's book in 1947. So we replaced the boxes with units of price because we're not using that box grid anymore. We're thinking about units of price, and we're going to start thinking about units of time, which you don't have on a point and figure chart. The reversal is by 3. You can change that as a variable, and the break is by 1. That's the filter, and it becomes rules based. So this grid effectively gives you the rules base for using these charts. So we get this idea of a unit size. We coming off a low, we've got 1 unit, 2, 3, we've got all these units, then we pull back by 3 units at least, and then we recover and go higher by at least 1 more unit. And so that is the setup that we've taken from a point and figure chart to display on a time-based chart. So you can have the unit size is normally based on the price. So here, for example, we're just using arithmetic box sizes and not log scale. For US dollar, euro dollar, you would use 1 cent, which is about 1% of the price. Here, for the NASDAQ, you would use 250 points. So we're using a percentage of the price, and the rule of thumb is 1%. Although I'm finding on the daily charts, 0.5% log is producing the best results. But that's the arithmetic based on the price, and the unit size is effectively the sensitivity. So here, if we go from 250, so here's 250 points as the unit size on the NASDAQ 100. Now, if we use 100, we get more targets because there's now more sensitivity in the chart to produce those targets. So it's interesting that changing the unit size will change the sensitivity of the chart and will introduce either decrease or increase to targets. So small unit size means more small thrusts and reversals generating more targets generally. So the way to think about this in terms of time horizon is that 0.5% is a good number to use on your daily charts. 0.1% is quite a good number to use on your hourly charts. Now, as it happens, Updata knows this. So basically using 0.1% there, you can set those you can set these as using 0.5% there. So if it's a daily chart, medium term, it will use 0.5%. And if it's a short-term 60-minute chart, it will use 0.1%. You could change that to use 0.05% if you wish. And so that's a really key thing. And I go right down to using them, if you're trading, I go right down to using them on 1-minute charts. So this is 1-minute charts, and here you see the unit size is 0.05%. And there, the targets are really sensitive. And so that's crude oil falling away. It's up on the day, but we can see we've hit selling thrusts, and there's 1, 2, 3, 4 targets that have emerged in the last 3 hours on the 1-minute chart with a smaller unit size. Now, if I increase the unit size, you can just click here, and if I increase the unit size, that would reduce the number of targets. So, and then on the weekly charts, I'd use 1%, and you can go up to even longer term. and then right down to the short term as well. So chart frame is a really important aspect, and if you've watched my charts today, each day, you'll see how much I'm flipping from short term to medium term to long term, and and sometimes I'm going right down to very short term, like 1 minute charts. So that is probably one of the most important lessons of using these targets, is just remember your time horizon. So if you're looking at a daily chart, we're thinking weeks ahead. If you're looking at a 60-minute chart, we're thinking days ahead. And when I write my morning call reports, what I do is I look at a 60-minute chart for my overall roadmap, and then a 10-minute chart for calling today, and the hours ahead. So the time horizon is a really important aspect, and that's lesson 2. It's day 3, target notation and activation and negation, understanding the status of price targets. So we use a traffic light system, and it's understanding this target status. So obviously green is bullish, if you like, go, and red is bearish, that means a fall, and that you may be trading short, so that may be to your advantage. But upside targets are in green and downside targets are in red. You can change the colors if you wish, but most people really understand the concept of red, green, and orange. If we go higher above this point and activate this target, it will turn green. And equally, if we have an orange downside target and we go below the level, it will turn red. So the more recent targets are of greater importance. So these ones have been met, obviously. This one was given a while ago. That target there now has a little bit more credence, if you like, because we've got new targets pointing upwards. And if we activate this target, then we look to those levels and then this level. So the more recent targets are key, but also the target levels. We always look to the first level and then the next level. The target notation is this is the target value that we show that in text, and we show a percentage. These are the ones for not reached. These targets are bolder because they are still in train, they are still active. These ones have been met or exceeded, so they are now less bold because they no longer matter because they've been met. And then these are the activation levels, which we have in Updata in blue. So this is a target not yet activated. So that's quite key. And all of these are configurable in the indicator settings. So you can go here in Updata, and if you want to configure the appearance, you can do so. And also, if you go to the chart properties, there's a whole series of settings that you can set for the targets. I do recommend, to begin with, you don't change these, but if you want to email our help desk, they will tell you, how you can actually activate these targets. So really quite key that you probably just use the default settings to begin with. But you can see here we've got the Linton Price Targets, and so that's where you can decide to change them. So here there's a whole series of settings, what you want each chart to show, etc., etc. And this is way more powerful in terms of settings than we can ever achieve on other trading platforms. So the status of the upside targets, thinking about these targets, is basically you have a new target. It's activated if you move 1 unit above, so that's the activation level. Remembering you need a low, you need a thrust off a low, you need a reversal low point, and then a move 1 unit above that level. And so that's a target activated. If you get to the target price level, that's a target has been achieved. And I'll talk about that in a minute. In this area here, we call the target. I tend to say the targets are in train. You may well start to see, and this is the real value of seeing these on time bus charts, is you might start to see the target is running out of steam or it's exhausting, or remembering the last lesson, you might go down to if you're looking at a daily chart, you might go down to the 60-minute chart and see whether there are new downside targets emerging, and that would give you some concern over that target. Here, if we move back below the activation level, effectively, we're back into this range. The target is, in effect, deactivated. That's new notation, really. And then if we move back below the pullback, the target is starting to fail, so we start to be more wary. And then the target is negated, which is point and figure rules. If we go below the point at which the thrust was gone, all those buyers they've left, they've sold, and therefore the target disappears. It's no longer there. I will talk about negated targets in a minute, but that's the key thing. A downside target is the other way around. You have a selling thrust off a high point, a reaction, and then move to a new low. You then activate the downside target, and here the target might be exhausting. Here it's deactivated, and again, if we make a new high, then all those sellers have exited their position. So it is worth just understanding where you are on that target roadmap as they occur. As I mentioned, there's lots of settings in Updata. You can change the colors. It's really, really powerful, but my recommendation is you just live with the default settings to begin with, and as you get more proficient with the targets, you can change them. So here the targets are in train. Now we've got a very interesting situation where we're in a bit of a sideways range. If we go higher, that target turns green. If we go lower, this target turns red. So really quite key. And here we've got a target that is active, that we've still got a downside target is active, but it is becoming less valid as we start to see these new upside targets. And of course, if we break higher, we really start to discount this target. And if we make a new high, that target will disappear. It's negated. So the key thing is that there are two types of targets. There are the target in terms of negation is a target that is negated before it is activated. You should always wait for the target to be activated. So here we have an orange downside target. Here we've got a target that is given to the downside, but it never changed from orange to red. And so here, this target, when you move higher, is activated. So a target that is negated before it is activated is much more common than a target that is negated after it is activated. Now, you do get targets that get activated that then fail, and they are negated after activation. But as I say, these happen less frequently. Now, you can show these targets on your chart. So if I go back to, let's have a look at Brent crude on a 60-minute chart. And if I go to the actual contract just to help with the rollover, I could add in the negated targets. And so this will show you activated then negated. So there were some targets that were activated. This one was activated, and then it was negated with a move below. So this just highlights that you will see targets that are given, but in this instance, you're here and you see this target to the upside. This one is not quite met. That's what we call bearish confirmation. And then we start to see the pattern that we're breaking down. At this point, you say, I only really believe in this target now if I break to make a new high. So you've got to use the price action with the targets. You can show these, but I think they're generally a distraction. You want to just know which targets you're seeing now. So the key thing to remember is that you can get targets that are negated before they're activated. Those ones really should be ignored. And you can get targets that are negated after activation. And in back tests, we do look at those because you will have had the target at the time and you may have well entered the trade. So that's day 3. And so the key thing is just understanding all the notation of the targets and understanding where you are on the trajectory of the targets. Day 4. I mentioned at the start of this that using the price targets in in isolation without understanding the trend and the key price levels is they're not going to be anywhere near as powerful. If you said to me, what's the most powerful thing? I'd say the trend. And if you said, what's the next most powerful thing? I'd say the resistance and support levels, which are automated with these levels that I'll show you. And then the targets. So the targets are the icing on the cake, really. So it is vital to consider trend and support. So trend definition and targets. Price targets with the prevailing trend should be favored. And that's the thing I will get sometimes someone saying, oh, the target didn't work. You say, yeah, we're in a downtrend and you had an upside target. You have to discount targets against the trend. Doesn't mean that they won't be met. It's just that you can't give them the same level of weight. So here on a midpoint average, that's just one of the things that comes out of Ichimoku charts. This midpoint average is a tool within Updata, and you can put that on your chart. So if I go to, this is a 60-minute chart. Here I've got a cloud. I could just go back to a candlestick chart, and the midpoint average, you will find it in the tools menu. It's right at the bottom. And this is basically, there's a big argument for using these, I think, because we're more and more in 24-hour traded markets. What is the close? And moving averages are really calculated on the close, whether this is the midpoint of prices in the trading range. So that's one way of doing it, but actually my preferred method is clouds. I love the clouds. But the key thing is you need some kind of trend definition, and you would favor the downside target in a downtrend, and you would favor the upside target in an uptrend. And that filter is really important. Now, if you want to understand cloud charts, and if you watch me on Charts Today each day, you'll see I'm using cloud charts the whole time. I wrote a book on cloud charts, which is where that time horizon table came from. It's somewhere in the book here. Pretty early on, I would say it's in the book. In fact, I say that it's when we look at multiple time frame analysis. And so that table was very much an aspect of the book. There it is. It's no longer in hardback, but you can get it on Amazon in paperback. And this covers a lot of technical analysis, but it really is probably still the only book really in English on Ichimoku charts. So if you want to understand those, and you'll see me using the clouds every day in chartstoday.com. So I would again favor upside targets above the cloud and downside targets below the cloud. How do we define support and resistance? And this is a tool that comes with the targets. It's basically these are levels, and it's really simple. You could probably program this yourself if you're a programmer, but basically we've got quite a nice notation here. These magenta ones is where the last level was broken, so it's nice to see the level that's just been broken. And basically it looks for bars either side of a point and says, okay, and if I recommend 3, but you can change this. So if I go to a chart and you can see these levels are placed on the chart, I can just literally go and change the levels. And if I change the levels, that will change. So now that's looking at 8 bars either side of a high low. This is 5 bars, 3 bars either side of a high low. You can show the last 20. You can show the last broken ones, which is those magenta ones. And you can extend, if you wanted to show more levels, you could just go and show more levels on your chart. They're all marked on there. So really, those levels are really critical. And if you're watching my charts today, each day, you'll see that. And in fact, in my screens in Updata, I even go further and have all those levels placed in my screen. So we'll come back and have a look at that in a minute. It's going to calculate all of those. So that's how we define support and resistance. And you can increase the bars for more significant turning points in price, but I do recommend 3 bars. That normally picks up the good ones. Now, what you really want to be doing is watching for the levels lining up with the price targets. And when that happens, that's gold dust, because here we're breaking a level and the target is suggesting that we're going to the next level. I can really place extra weight on that value, because it is, quite a good chance that we fall back to the next level of support, which is also where the target is. So watching for targets lining up with levels is really quite key. So don't forget to always check when you've got the targets that they are lining up with levels of resistance and support. That's a really key factor. So lesson 5. Key thing is you can have multiple price targets and conflicting targets. And when a target's stronger and weaker. So clustering, when you get multiple targets, is what we call clustering. When you get multiple targets pointing to not only a price area but also a time area, this becomes really, really valuable. And we'll talk about the time projections shortly. You might notice this is like an ascending triangle pattern here. We use all the same technical analysis tools. We see patterns, and that is really quite key. We're pushing, and we can see that breakout level and where that then takes us. The idea of the triangle is the height of the triangle is the move, or if this is a consolidation, the move into the pattern and then the move out. So really, really valuable. So multiple targets increases the likelihood. And I think the simple rule here is if you have two targets pointing to the same area from different buying thrusts, that means they're twice as likely to be met. It's a bit of a rule of thumb. You can't argue that precisely, but if the more targets you have, the more likely it is you're going to that area. Different buying thrusts producing targets to the same price target is really, really powerful. The interesting thing is that you may see a fall before you see a rise. So here we've got two upside targets, we've got a little downside target. And so this is the last target, this is the last thrust. And so, you may notice this quite often, that you've got conflicting targets. And this might mean that you're going to go lower before you go higher. You really, in calling this target now, I want to see a break above this 311 level. That's the resistance level that's automated on your chart. I want to see that level broken, and then I start to pay more attention to that target. Equally, if I break this level, then I start to look at that level much more seriously. At the moment, there's uncertainty because you've got buying and selling thrusts in different directions that are pointing to different targets, and so that's the uncertainty of the market. Watch out for target activation. So here, and if I was writing a report, typically I would say, we're bearish below 284 here, and if we move above 321, then I start to look at this target. So really quite key. Resolving conflicting targets, and you will get them often. The trend is your friend. So more downside targets is key. Remembering this idea of targets being achieved. So if a target is achieved, that's a bearish confirmation to the downside. If an upside target is achieved, that's a bullish confirmation. And we'll talk about that as we go through the lessons. So the key point there was that targets are approximate. So interestingly, this is my screen, and I have the trends, I have the resistance and the support levels, and then I have the price target. So this is a bit hard to understand, but I do. It reads the chart values in, and I can see the trend state, I can see my price levels, and I can see my targets. You may not want to go to that level of detail. So lesson 6, targets are approximate. So we'll think about trade construction, and we'll think about some of the pitfalls here. There is no silver bullet. So to increase the accuracy of targets, we think about the time frame, we think about the price levels, and we think about the trend. So time frame, support and resistance, and trend state, those are all really key. So always note the key price levels. So here we've got an upside target, but right now we're nudging resistance. So, and I like to say I want to normally see 3 days or 3 bars above a level to really feel that that level has been broken. And then I might expect a resistance here before we get to this target. So it is important to understand the support and resistance is often more important than the price target itself, because those are the actual levels where people bought and sold. Always study the wider chart. So, this is going back in time, looking at the wider chart, looking at those support and resistance levels is really quite key. We've got mixed targets here. The last targets that were met, so that was bearish confirmation. These ones now not being quite met. This is a situation where there's uncertainty, and that's the fact. You've got selling thrust and buying thrust producing two downside, two upside targets. If we break lower, then it's those targets. If we break higher, then it's these targets. At the moment, we are starting to break higher. The last two targets have been upside targets, so you would tend to favor those. But also don't forget to look at the 60-minute chart, which will give you short-term targets as well. The more recent targets are stronger. So here we've got a target. This was the Dow Jones Index. Here we've got a downside target, but now we've got a new upside target, and this target may now be done. And certainly if we break to a new high, we deactivate that target anyway. This one is now less valid. It was given a long time ago, but it's still there, and if we break to a new high and we pass this target, it might be the only target we have, remembering we need a pullback to generate the next price target. So when a target's no longer valid, this is a key thing. We tend to focus on the nearest targets first. This one here, you might say, was nearly met. It's a little bit of bearish confirmation. Then we had some downside targets that were met, but I'm really not thinking about this target anymore. I'm now watching this one and that resistance level. At that level, that's really quite key. But this target is probably no longer important. Targets being exhausted. So this was Coca-Cola. Notice we made a lower high and then a lower low. Do watch my Dow theory session in the resources, how to know when the trend has changed. And so that lower high, lower low, that then just says to you this target is probably not going to be met because the target is exhausting. And then we get some new targets, so we've got a new downside target and a move below that level, and we start to look quite seriously at that target and notice that it's all the way back to where the previous support level was. So we really can put some value on that target. So an upside target not quite met is bearish confirmation. That's a little bit of bearish confirmation, and so you would be bearish certainly when you get the lower high, lower low, and you say, "Oh, that's bearish because we just didn't quite get to the target." Beware of improbable targets. This often happens on long-term charts where you had extreme buying thrusts. It doesn't mean to say that target can't be met, but it just, I would want to look at other charts like the 60-minute chart or other targets, other box sizes even. Careful with long-term charts especially. So here's one of gold saying gold's going to $13,000. I mean, in 2040, maybe it will get there, but it's a very long, far away call on a 5% chart. So it just may well be that it's exaggerated, and there is a lot more to look at in the shorter term to call the next levels for gold. Beware of charts with big moves. So, Bitcoin was a good example of this. We have big moves producing big upside targets. And again, this is a long-term chart. We put that on the chart. It's a weekly chart. So again, you have to be careful with that. You will also find data variation with different providers. So this one's from Bloomberg. This one is from LSEG, feeding into Updata. And here you've got the slightly different data. And it's slightly academic. The targets are very similar, but you will sometimes find the targets are different. And that often happens when you look at something like gold. If I go and type gold in here, I've got lots of different providers of gold, and I can go here and I will get slightly different targets because those providers have different data for their trading in gold. It's their trading data, and so that can be a factor as well. That was in TradingView. So day 7, that's the next lesson. Should you use log scale or arithmetic? And it depends on how and what you trade. So using a true 0.5% log of price, the beauty of this is that on any instrument, I can just, so when I do my tracker charts on any instrument, it resolves the box size. So that's a really key thing. So here on TradingView, it will resolve the box sizes to use for the targets. Same in Updata, which if you're using tracker charts in Updata, it will literally deal with the fact that the euro is here is using 0.1% of the price for the euro, and that's going to be a tiny value. But then something like, I don't know, the Nasdaq, this is now gone from $1.16 to 225,000, and so it's using a percentage still 0.1% of the price. So that's where the advantage of using log scale is it just works it out across each one. Now, there is a bit of intelligence on arithmetic boxes which will try and find the nearest box size, but I use log. And the interesting thing about log scale charts is the targets can be a little bit exaggerated to the upside because the box sizes, the unit size is getting bigger and bigger in percentage terms as you go up. But interestingly, to the downside, the unit size is getting smaller and smaller. So upside targets will be exaggerated and downside targets will be less exaggerated. Here we see Brent crude. This is using 0.1% of the price. So the argument is if you trade just one thing, then it may be better to use an arithmetic unit size, not log scale, because you will see the round level. So here we're using 10 cents for Brent crude. So every move through 10 cents is basically going to be pretty key. And that's where those levels might be more important. Here we're using a 5-cent chart, and it does mean that all the targets are really clear round numbers, whereas in the log scale they will be not. But if, like me, you're looking at lots of different charts, you're looking at lots of stocks, then you'll want to use log scale, and it will resolve the fact that it's using 0.5% of the price, and you can then look through lots of different charts. So that's the answer. Should you use arithmetic or log? If you're trading just one thing, do look at using arithmetic because it'll go through those key levels. But log scale is really the setting that we recommend. So a key factor with price targets is achievement and non-achievement of targets gives us a clue to the bullish and bearishness on the chart. So if a target level is achieved or exceeded, that's bullish confirmation on an upside target. If a downside target is not quite reached, that is also bullish confirmation. We basically had bulls coming in before the price could get to its downside target. So remember, this is an initial wave of buying, and then this is the resultant. And here, that wave of buying is confirmed with the target being met. Here we've got a downside selling thrust, and that wave of selling, we don't quite get there, the conviction, or there's a sentiment change on the way to that price target. So that's an example of bullish confirmation. Upside targets achieved or exceeded, downside targets not quite being met. Bearish confirmation is where you'll have an upside target not quite reached. That's slightly bearish. We looked at that example in the last lesson. And then you'll have a downside target which is exceeded. That's bearish confirmation. So if you exceed a downside target, that's bearish confirmation. Remember, if you don't reach it, that's bullish. If you exceed it, that's bearish. If you don't quite get to an upside target, that's bearish. So that's just a key thing to remember, that you're gaining information when you see those targets being met or exceeded. So knowing when a target is exhausted, and this is a really key factor, is that here, we looked at one example in the previous lesson, but here you've got this upside target, you then don't quite get there, and now you're starting to fall away, and at some point now you're getting a downside target generated. You might look at the 60-minute chart. This is a medium-term daily chart. You might look at the 60-minute chart and see downside targets being generated, and that's telling you the short term is turning bearish. That is contradicting, the trends are not lining up anymore, and that is a form of bearish confirmation. So this new selling thrust just confirms that this is not an inherently bullish chart, even though we might think it's got an uptrend. The key thing is we're not quite getting there. So always look for new targets, signs of a lower high, a lower high, lower low. That is really significant. You can just completely discount that target now. This is the one. Just remembering the status that we covered previously of upside and downside targets. This is one of the really big advantages of not having them on a point and figure chart. On a point and figure chart, they'll just be pointing up in the air, and you will not see this price action necessarily on the point and figure chart, whereas on the time-based chart, you can even just see you're wandering away from the trajectory. So that's quite key. So how well have the targets worked? We trust targets less if they haven't worked well in the past. If they've worked well, even here on the downside targets, and we've got a new upside target, if the targets have worked quite well, we trust them more. So day 9, time to target. So don't get too obsessed with the target time or the level of the target. The most important thing is that you've got a target. But what we're trying to do now is we've got the factor of the target, is how high are we going to go, and that's the default for that is 2 times that initial move, another 2 times. But how long is more about method. So the price target level is a factor, and the time to target we think about more method. And probably the longer, the greater the upside the target, probably the longer it's going to take. So you've got big targets, that's going to take longer. In point and figure charts, the first rule is that the targets have no time scale, and this is something that we aim to try and understand. How long will it take? And there are 5 types of time to target projection. My preferred one, which is the simplest, which is a price time ratio. And so that's just, I like 2 to 1, which means that for every 0.5%, that's going to take 2 days. Sorry, every 0.5% of price is 1% of time, which on a daily chart would be days. So 1% would take 2 days, if you like. The thrust angle is another one, time to activation, follow the price, and I'll just quickly take you through these. The time price ratio is my preferred one, and here we can see we've got multiple targets on Intel. This is a 2 to 1, and so this says 1% every 2 days because it's a 0.5% unit of price. Has this been right? Probably 3 to 1 is a bit more accurate. And so you might say, well, then 1.5% every 3 days. Remembering that's how long it takes in the target trajectory. But it is slightly academic, and we'll look at doing this practically in a minute. Thrust angle is basically just says I'm going to use a multiple of this angle. So this is half the thrust angle. So it says if the thrust happens more quickly, then the target will happen more quickly. Not a method I use often. And the other one is time to activation. It's in there as a method, but again, comes down to personal choice. Follow the price. This one just says we don't really know how long it's going to take. And so what we're doing is we're just going to follow the price. We ignore the last n bars so we can actually see if we're diverging from that price. So if we start falling away and we've ignored the last 10 bars, we can actually see it because it's just following the price 10 bars ago. This one's quite nice, and it just accepts, look, we're just going to track the trajectory of the price and see how that looks. And that means the targets are no longer parallel. They point in different directions because they're given at different times and they're tracking through that price. And the last one is a sort of semi-back-tested where it basically says how long have targets taken to be reached previously. That's what we're going to use. And that sounds very alluring. But the most important thing, so here's the last 50 targets, and this is the average period it takes for these targets to be met. And you can see it's drawn them all to where they were met, and that's, here we say we've got, it takes 0.35 for an upside target and 0.298 for a downside target. That's the time per 0.5%. So here's NVIDIA, the last 50 targets, and it's just trying to work out. So here, up targets is 0.41 units a day, and down targets is 0.36 units a day. So just telling you how long they take. The most important thing is that you've got a target. I almost never use anything other than the just the trajectory. Here I'm using 2, that's my standard trajectory, and as I mentioned, you can change this. So this is just 2 to 1 on Bitcoin, and it just says for every 0.5% that will take 2 days for 1% of the price to move. Now it may well be that I want to change the trajectory. The new key for doing that is the X key. You can also do it here, and these two are locked in unison, so you can play with these periods if you want. But 2 to 1 seems to be pretty good, and what I do say to people, in fact, the system remembers what you last had, which is my targets were a little bit deeper to begin with. I was using 1 to 1 on Bitcoin. It remembers that in the chart. The key thing is, the fact is I've got a target. Don't get too obsessed with when the target will be met. It is just helps you visually to see, how long it could take. And the key thing is, once I break lower, then I believe I would move, like here, quite quickly to that target. So that is lesson 9. Lesson 10 is a big one because it also includes some of the new features in Updata. So this is the biggest lesson, really. So taking your targets to the next level. So the level settings are pretty straightforward. I explained that in an earlier lesson. The averages, if you want to use the average, that's very straightforward. You can actually use close or high-low in the target calculation, which again is an advantage in Updata that isn't necessarily in all other systems. But you can see here we're using close. You could use high-low, you can use open high-low, and you can even use open high-low, which will help you understand which one came first. But it's quite technical. I just use close prices. Again, the most important thing is you've got a target. The target factor, and again, in other videos we go through this in more detail, but the target factor, I'm using 2, but you could use 1, you could use 1.618 if you wanted. So again, the choice is yours. And then if I go to pattern, so that is the idea here is that the move into the pattern, the move out is equal. So you'd use a target of 1 maybe if you're trying to say, that's the pattern. Fibonacci, I mentioned you can use 1.618. 2 times is the classic point and figure one, and 2 times log scale, which will make those targets bigger to the upside and smaller to the downside. The most important thing is you've got a price target, and once you've got a price target, you can then, it comes back to that money management thing with Murphy, that you can then manage the trade. You can adjust the pullback. So if you use a bigger pullback, that's like a slingshot. The bigger the pullback, the bigger the thrust. But really, I do recommend you just stick to the 3 reversal. You could use a 2 reversal or a 5 reversal, but really I recommend you stick to 2. So this slide, if you are studying the slides, this just helps you understand which bits in the dialogue refer to which areas. So here, for example, if you chose high-low, that's there. If you chose the factor, that's that slide. This is the time price factors. There's 5 projections, which I've talked about in the last lesson. This is where you could adjust the reversal, which I don't recommend you do. Here, should you use log, scale, or arithmetic, and understanding the target status. So this slide just helps you understand that, and each of these have been covered in the presentation. Settings on Updata, you can see there's lots of settings. I showed that dialog in Updata. You right-hand click on the chart and go to Chart Properties and look for Linton Price Targets, and you can change there. This is the appearance, which you can also change, but again, a very small group of people will want to do that. So the way to visualize these is, this is the unit size, here is the reversal size, this is the factor, and the time to target is this one. So there's quite a lot of settings, but I'd really just recommend you start out using the default one. So one of the new tools is on balance volume. Now this is a chart of crude oil in the Middle East crisis at the moment, and Trump's tweeted something and the price collapses. And what I want to see is how much volume is behind that target move. So this is the on balance volume, and it's measuring the on balance volume and then the volume during the activation period. And what we're seeing here is the on balance volume is actually moving higher, and that there wasn't a lot of volume on that target. So here we're seeing quite significant amounts of volume both during the activation period, which is telling us that's potentially going to be higher, and then of course the on balance volume is making a new high here, and it's not making a new high in the price. So it just helps you, if you see gaps, targets that are produced by gaps are not volume driven, and again we might discount those slightly. So that's just a new feature within Updata, and the way to get to that, if I go back to Brent crude, this is the actual contract. I can actually go and put the target OBV on, and it will be a chart type. And where is it? Here it is, right at the bottom of that list. And it's going to see the volume. And so what's interesting now, that example was a while back, what's interesting now is that there's real selling volume. This is an unactivated target, and we can see there's quite significant selling volume in that on balance volume. This is a 60-minute there. So we have recovered a bit in the volume, so we haven't activated that target yet, but it does help us understand, and the amount of volume during the activation will show up when we activate. So that's another tool. I did mention the midpoint average, so we can actually go and put that on as well. That's in the bottom of the tools menu. We call it the Linton average, and that just helps us understand again that you can see here that we are below the cloud, the downside target, below the average. I could also go and put the cloud on, which is my preference, and I can see also that I'm below the cloud. So I would discount this average at this target at the moment. I've got a downside target that's been met. That's confirmation, bearish confirmation exceeded, and now I'm waiting to see this target. And of course, then I would look to that level 90.40, which is really quite key. Now that's that average. If I go put it on again, it's actually slightly comes from the the Ichimoku chart, but that's how Ichimoku charts are calculated. This is a midpoint average, and I could actually do a midpoint overbought oversold, which is, and there's a whole series of these tools that we're adding all the time, so quite interesting there as well. So do keep an eye out for those tools in your Updata system. So yeah, there's more and more of these tools that you can look at. There's even a Linton MACD. So this is going to use midpoint averages to calculate a MACD. There's a lot of research tools in train at the moment. So, but the big one is the stop losses, which is really what I want to show you now. So if we think, that just shows there. Now, target stop losses, targets may not be reached or exceeded. Cut your losses or let your profits run. So if you think about it, statistically, a target is either less likely to be met or reached, or it's going to be exceeded. So the fact that it's met exactly is less likely than, sometimes it does happen, but often a target will be not reached, so you want to stop to get you out before that happens, or it will be exceeded and you want to run that profit and keep going beyond the target. So this is the whole point of stop losses. So remembering that money management from the Murphy book, the idea is that you decide on the trade, you want to be able to make a price projection, you enter the trade based on timing, and then it's all about managing the trade, and that's where stop losses come in. Now, stop losses are actually my first love. I wrote a paper for IFTA. This is where I was awarded my Master's in Financial Technical Analysis. This is the web address. It's the IFTA Journal 2009. You'll need this exact web address to get to it because it's now no longer listed on the IFTA site. I wrote a book back in the early 1990s called Profit from Your PC, when computers were just a thing, and a big part of it was when to sell, and optimized stops was very much a thing that I started out with. And in various books, when we get to things like trading rules, where I've been featured writing in these books, various rules I use all the time. I say, cut your losses, let your profits run. That was very much my mantra. Cut your losses, let your profits run. And the way to do that is with stop losses. So we've been working on a series of stop losses that we've put into Updata. These are in the latest version. There's basically a whole series of stop losses that go with the targets, and I'm going to show you these now. So the idea is that once you're in the trade, it's all about managing. And so you'll have a target. The risk is you won't get to the target. You want the stop to get you out if that doesn't happen. Or you may go beyond and you want to stay in with a stop. So you're accepting that a price target will not necessarily be exact. Percentage sets a user-defined percentage of price. So this is just a simple, you put in your percentage, here I put in 1.5% long and short, and that's fixed. And so it produces these from the targets. And if I take a gold chart, that was a 10-minute chart of gold. So let's just go and set that same chart up. And here we're going to go to a 10-minute chart. It pulls this data in, and I'm going to hit the T key. It's going to put the price targets on for me. I'm going to just go back a little bit because there will be more targets, and I can see already that my targets are a little bit steep. So I'm just hitting the X key to change the trajectory a little bit. And now if I go and look at this tool, which is the stop loss tool, Linton Price Target Stop Loss, and now I can just put the percentage one on there, and that's what they look like. So they start from the activation point of the target. So this runs a short, but the key thing is there's no intelligence here. I've just used 1.5%. So that's a traditional hard-coded stop. Weighted is basically where it will look at the last, you give it a period, so you say, let's look at the last 5 periods, and it will basically use a weighted calculation, so it'll apply more value to the last period, 5, 4, 3, 2, 1 on 5 days. So it gives more value to the last day, but it will go through and work out what percentage you should be using based on so it's 1.5% of the 5-day average of price rather than today's price. So that's a weighted average. The exponential is an exponential calculation. So that basically uses the exponential calculation and looks again here. I've used 5 days. You can change the period. You don't want it to be too big because you want the stop to be relatively sensitive, but that will then pull in. And so it's using an exponential calculation to arrive at what's the value, and then using a percent on that. And then average true range is, this is on Wells Wilder's. This is the groundbreaking book that Wells Wilder wrote in the 1970s. I think it was 1976. And average true range was his classic formula. You can apply that. You can even apply that for unit sizes for the targets. But average true range is where we look back over a period. We look at a standard deviation and we arrive at what's the average true range of the prices now. And so that's quite a nice stop. And then dynamic, this is one of my favorites. And so basically this one is we set a threshold. And so let's say we've got 1.5%. We set a threshold of 2.5%. And what this says is if the price moves away 2.5% from the stop, then actually what's happening is the price is running faster than the stop. I want the stop to tighten up. And so if that happens, we tighten up by 0.25. So we then go to 1.25. So this is a really quite a nice way. It's a bit like a parabolic SAR. By the way, all of these are interchangeable. So you can literally go and do the dynamic stop, and it will just now apply that 1.5%. But if I did it on, say, a weighted stop loss, you'll notice those stops just slightly move. And there's not a lot to it. I've used the exponential one, that one, but I used 2.5% here. It remembers the settings that you set. So each time you change these, you notice how the stops change. So you can kind of curve fit. And then if we go back to that dynamic stop, I could change the threshold. I could even change my dynamic stop level. And you'll notice how that is changing the stops. So really quite key there as well. So the dynamic is quite good if the price starts to run away. Best fit basically finds the best values for each target historically. So it says this one, but actually there's a thing here at the end where it says, so just show the last ones, and this is quite nice if you're looking at where are we now. I just want to best fit where we are now, best fit the stop loss. I set levels, and I'm going to just say last trades only because those previous ones are not so important to me. And what's really interesting here is for that stop there, the best fit is still in train, but here that's just showing me the stop that best fits. It's 1.1%. You can see I've got a step here, but that is really quite cool. And then optimized, which is actually one of my favorites. This and here you have to set a range. I go recalculate, but if I go a minimum and a maximum, and if I set that is 2, and then my step and recalculate. It will move those stops, and it tells you up here, it'll tell you what 1.75 short and 1% long were the best fit stops. So in this instance, it's looking at all the previous trades based on the targets that are shown on the chart. It's looking at all the previous trades and saying that's the one that worked best. 1% has worked best on the 10-minute chart on gold based on the targets. And you can see here, if I go and show more targets, it's basically, so here you've got a good example of where that target was exceeded and another target came in. So you would have run that trade all the way up to there. Here we've got trades, another one, target was exceeded. You would have run that trade higher. You can see here, got another one. Actually, that's because these ones worked well historically, it has taken you out early here. Now that is because they worked well previously. And so you have to decide, how far do you want to look back in terms of your charts. So that's how the stops work. Here, this is a feature that we're not yet releasing in Updata, but I'm using it to see which stops work best. And I can see, for example, here on this one, which was the optimized stop, we stayed in the trade longer. Here was the dynamic stop, which rises up or tightens in, meaning that we stay in the trade less long. So the interesting thing is I can start comparing which stops work best, and I hope to be able to provide you with intelligence on which ones work best soon. We're back testing them all the time and doing a lot of work on back testing, and again, that's a work in progress, which the back testing feature will be most powerful in Updata. Scanning for the targets, this is again something that's really powerful in Updata, and I've got various scans where I can go and scan for the targets, and if I wanted to write a new scan and I go for the price targets, there's a whole series of things. I can scan for multiple targets. I can scan for percentage to target, how far into the future, whole series of things that I can scan for. Do look on the Updata website under resources. You will find videos on there. So you can go to resources, lots of free resources here. When you go to videos, you will find 2 videos there on scanning, where I scan huge universes to arrive at the handful of stocks that are producing upside targets or multiple upside targets. So scanning for targets is a really powerful aspect within Updata. So the key points about the targets is that they are approximate. Not all the targets will be achieved. Targets pointing to key price levels increases the likelihood in terms of resistance and support levels. Multiple targets pointing in the same direction, clustering increases the likelihood. The nearest targets must be met first. Beware of improbable ones. Targets not reached or exceeded gives you an indication of bullishness and bearishness, and you can have opposing targets. Remember to favor the ones with a trend. Do understand this idea of negation and activation, and to make them even more effective, use stop losses. Really interesting when you look at this chart. Here the price is lower, but the equity line of trading this over the last several weeks is higher, and so it just does highlight that whilst we're going up and down, you can, with the targets and the stops, improve your trading results. The stops will actually make a bigger difference to your equity curve than the targets, but using both together makes them very, very powerful indeed. So those are the key points to remember. You keep your skills up. Do watch these videos, read the paper, follow me on LinkedIn, watch charts a day every day. Do look at my LSEG surgeries. There's lots of those there now under resources. Those are for market professionals, but I do show these resources all the time in Updata, so you can actually go and look at these resources. It's really powerful. And there's now over a dozen ones. I'm doing one next week on relative strength, speaking at various conferences, and speaking at the IFTA conference in London later this year. And of course, you can get my book on Ichimoku if you really want to understand that. The other thing is to get intensive professional training. Now, I do have an online training course. We do offer this sort of very discounted price to private users or individual users who are using our system. As I say, professional firms pay several £1,000s for these training courses, and you can get them for a lot less. Just reach out and we'll put you on the course. 12 hours intensive training, and it really does give you an overall grounded technical analysis training, and you'll find that under the training menu in the Updata website. The key thing to remember is trend, levels, targets, stops. And you do look at the resources. Do feel free to reach out, email t@updata.co.uk, and I will see those emails. I get a lot of requests, a lot of things that I cover, but I hope this helps you get the most from the price targets. Happy charting. Bye for now.